Chapter 5's fifth and last objective is to calculate another couple of key ratios that merchandisers use. One is the gross profit percentage and the other is the inventory turnover. What we do with these two ratios is use these to evaluate the business's performance. Okay? Again, we would use comparative financial statements to evaluate a company's own performance, as well as looking at industry standards for a retailer to compare them to industry averages as a whole. Gross profit percentage is taking your gross profit divided by your net sales. Now you come up with the gross profit by taking your net sales and subtracting your cost of goods sold. It's the percentage of sales dollars that's available to cover expenses and to provide a profit. Okay? Gross profit percentage, it's the amount of money or the amount of sales available to cover expenses and to provide a profit. The second ratio is the rate of inventory turnover, where we take our cost of goods sold, dividing it by our average inventory. This tells us how rapidly we sell our inventory. Okay? The average inventory is simply taking your beginning inventory and your ending inventory and dividing it by 2. And again, how quickly do we sell our inventory? So, looking at exercise E525 on page 290, we have Networking Systems earning sales revenue of $65 million in 2009. The cost of goods sold was $33 million, and net income reached $8 million, the company's highest ever. Total current assets included inventory of $3 million at 12/31/09. Last year's inventory was $4 million. The managers need to know the company's gross profit percentage and rate of inventory turnover for 2009. Please compute these amounts. Okay, so the gross profit percentage we said was taking our gross profit, which we found by subtracting cost of goods sold from net sales and dividing them by the net sales. Okay, so gross profit is equal to $32 million. I got net sales of $65 million less cost of goods sold of $33 million, so the gross profit equals $32 million. $32 million divided by the 69 is equal to 49%. So they have 49% of their sales dollars available to cover expenses and profit. Inventory turnover. Cost of goods sold from Part A, $33 million, divided by our average inventory. Our average inventory was $4 million last year, plus $3 million at the end of this year, divided by 2. So $33 million divided by 3.5 means that their inventory turned over 9.4 times. Inventory turned over 9.4 times. Okay, what does that 9.4 mean exactly? It means that the inventory had to be replaced almost 10 times during the year. So $33 million divided by 3.5 means that their inventory turned over 9.4 times. Inventory turned over 9.4 times. Okay, what does that 9.4 mean exactly? It means that the inventory had to be replaced almost 10 times during the year in order to satisfy customers' needs. Okay, on a bigger scale, think about a Walmart. How much inventory is in a Walmart on any given day? Multiply that by 10, and that would represent the inventory that was turned over throughout the year. I hope that example helps you in understanding inventory turnover.